Hi, ReAnn Gonzalez here with Edge Home Finance. Today, I want to talk about something I am seeing more and more with homeowners. A lot of people are holding on to a very low mortgage rate, and I completely understand why. Maybe you bought or refinanced when rates were in the 2s, 3s, or 4s. On paper, that looks like something you should never touch. But here's the part many people are not looking at. Okay, so now let's get into it. Your mortgage rate is not the only rate that matters. If you have a low mortgage rate, but you are also carrying credit card balances at 20%, 25%, or even close to 30%, then we need to look at the full picture. Because while keeping that low mortgage rate sounds smart, the real question is, what is your total monthly interest cost? Not just your mortgage interest, not just your mortgage payment, but your total monthly cash flow across your mortgage, credit cards, personal loans, car loans, and any other revolving debt. Here is an example. Let's say a homeowner has a low first mortgage rate, but they also have several credit cards with high balances. The mortgage payment may feel manageable, but every month they are paying hundreds or even thousands of dollars toward credit cards, and a large portion of that payment may only be going toward interest. That is where people get stuck. They are making payments every month, but the balances barely move. So while the mortgage rate looks good, the overall debt picture may not be good. Now, does that mean everyone should refinance? No. Absolutely not. This is not for everyone. There are closing costs. There may be a higher mortgage rate. There may be a longer loan term. And we have to look carefully at whether it actually improves your financial position. But it is worth reviewing before you automatically assume a refinance is a bad idea. Sometimes a higher mortgage rate may still make sense if it helps eliminate high interest revolving debt, improves monthly cash flow, and gives you a real plan to move forward. The key is not to look at one rate by itself. You have to look at your current mortgage balance, your current mortgage rate, your monthly mortgage payment, your credit card balances, your credit card interest rates, your total minimum monthly payments, your cash flow after all debts are paid, and how long will it realistically take to pay those debts off if nothing changes? This is the real conversation, because keeping a low mortgage rate while drowning in high interest credit card debt may not be the smartest long-term plan. Again, this is not about refinancing just to refinance. It's about running the numbers. It's about looking at the total cost. It's about helping you understand whether keeping the low mortgage rate is actually helping you, or whether it is keeping you stuck because the rest of your debt is costing you too much every month. Before you rule out refinancing, let's look at the full picture. Mortgage payment, credit card balances, interest rates, monthly cash flow, and your long-term plan. You may find out that keeping your current mortgage is still the best option, or you may find out that restructuring your debt gives you breathing room and a better path forward. But either way, you deserve to know the numbers before making that decision. If you are in El Paso, southern New Mexico, Fort Bliss, Las Cruces, Santa Teresa, Sunland Park, Alamogordo, Holloman Air Force Base, or White Sands, I would be happy to review the numbers with you. Before you rule out refinancing, let's look at the full picture. Your mortgage payment, credit card balances, interest rates, and monthly cash flow. I'm ReAnn Gonzalez with Edge Home Finance. Do me a favor and hit the like and subscribe button below to help my channel, and you'll get more videos from me on mortgages and real estate. Thanks for watching.